Hello, welcome back to our next chapter. Now we have shifted from Brilliance Growth Academy to Orator Academy, and now onwards, this academy will help you to academics, will help you in academics as well as your communication skills. So this is particular for academics as well as your communication. So if you want to learn your academics, then you can explore on Google and you can find the Orator Academy over there. And in the same way, if you want to go for communication skills, if you want to communication skills like presentation, personal developments, and any other skills that you may visit the same academy. So this academy is working for both academic as well as communication domain. So we are back to our next chapter, that is your chapter 9, that is a financial market, right? So business, we are talking about the financial market. What is the financial market and how it is useful for the current business situations, or why you need to study about this financial market, because you are studying the business studies, right? So in a first book or a first part of the business studies, we have completed our management related function: planning, organizing, staffing, directing, and controlling. Now we are moving on the second part, that is your financial management. Okay, so we are working on the financial management. So now onwards, you will study about your finance. So this is your business finance and marketing. So we have working on our next part, that is a business finance and marketing. So what is the meaning of the financial market? We are studying through this particular definition that is written over here. What do you mean by business finance and what do you mean by financial management? Business finance basically is related with the money required for a business, right? Because there are number of activities or the tasks that you usually perform during the business or in an organization. So all these activities are backed by the money. Without money, there is nothing or not possible any of the activities to be performed by any of the resources. So money required for carrying out the business activities is called business finance. It is required at every stage in the life of a business entities to establish, run, modernize, expand, and diversify your business or operations. So finance is needed both for buying tangible or intangible goods. As you know that tangible goods like plant, machinery, furniture, and intangible assets like goodwill or patent, trademark. So all are related with the business, and business can buy with the money, and money comes under the domain of finance. And so finance is needed both for buying tangible and intangible assets and for meeting day-to-day operational requirements. Now we are focusing on next part, that is the financial management, right? After studying about the business finance, you need to understand the what do you mean by financial management, how you manage your finance, how you manage your money. So you have to deal with that aspects in this particular part of the book. Financial management is a concern with the optimal procurement as well as the uses of a finance, and it involves identifying and comparing different available source of finance in terms of in terms of their cost and associated risk, investing those funds to generate returns that exceed the procurement cost. So this financial management or this definition will help you to understand how you get your money, how you get your finance, and how it will be utilized. So it involves identifying and comparing the different available sources of finance in terms of their cost and associated risk. I will let you know, if you are taking any amount of money from the market, then you have to pay the interest. So the interest you are paying is the cost or associated risk of that amount that you borrow from the market. So it involves identifying and comparing the different available option or different available sources, in sense how you can get your money, how you can get your finance. You can get your finance from the bank, financial institution, money lenders, or any other private institution who are ready to finance your business, your friends, your relatives. But some of the sources are associated with the charging money, that in forms of their interest or in their cost that they will charge from you. But some of the sources like friends, relatives, they will not charge you, right? Sometime. So to whom you have to pay the interest, you have to pay the principal amount back to whom you have taken your finance. So it is associated with the cost or the money that you pay them in form of interest or in forms of money or principal amount back to them. Because once you start taking the money, you will have to pay the interest. So if you have to run your business, definitely you need a money, definitely you need a finance. But there are some of the sources, or there are some sources that will help you to get the money, so you have to pay them back in terms of interest, in terms of principal amount. So investing those funds to generate funds that exceed the procurement funds, because every time you have to invest the money in your business, every time you get further finance from the banks or financial institution, so it definitely increase the procurement cost. Every time you approach to the market, sir, I need this amount of money for my business, this amount of money for my business, for a 5 lakh, 10 lakh, 20 lakh. So every time you have to pay the interest, or you have to pay back your principal amount to the financial institution or bank. So this is how you get your finance. But the problem is that you have to be very careful about how you take your money from the bank or how you take your money from the financial institution for your business. You have to understand its cost or associated risk. If your business fail to earn the money, earn the revenue, then you would not be able to pay the cost, pay the principal amount, or pay the interest. So you should be very careful in managing the money that you have already taken from the market, and now you are ready to take further. So in this case, you have to focus on some of the objective. What are the objective of the financial management? Financial management has two important objectives. First is maximization of a shareholder wealth, that is primarily concerned with the maximize the current market price of an equity share of the company. And second, value addition, ensuring that every financial decision is efficient and add financial value so that benefit exceed the cost involved. The first objective will help you to the maximize about current market price of equity share of the company, because as you know that people will invest in the company and they become the shareholder. If they are investing in the equity share, they become the shareholder, and shareholders wants to maximize their current market price of the share held that they held with them. So it is important for the company to always increase the current market price of equity shares by maximizing the wealth of the shareholder. So maximization of shareholder wealth only possible when the business is running at its momentum, at its right direction, at its right pace, earning revenue, co- uh, uh, incurring less cost. So in this way, the business will able to generate more profit, more revenue. So when the firms will highlight project a huge amount of profit or a good amount of profit in the subsequent years, or say from the years since when it has started its business, from that time, or it covering 2 to 3 years after that time, they have shown their profitability, their their profitability, their revenue growth, and for subsequent year they have generated a huge amount of profit or sometime a good amount of profit. So in this way, they will help to maximize the shareholders' wealth. They are able to increase the current market price of their shares on which they are trading. Second, it is a value addition, ensuring that every financial decision is efficient and adds financial value so that benefit exceed the cost involved. As a manager, as a financial manager, you have to manage your finance and you should focus on your financial decision. That should be so much efficient that it will help you to reduce your cost of getting the more benefit. It will focus on reducing the cost involved in the operation so that you can then generate more benefit and more revenue for your shareholder or for the equity shareholders or for their profitability. So these two important objectives you need to keep in your mind always time once you are dealing with the financial management. So you can manage your finance by increasing the maximization of shareholder wealth. Second, you can add value to your business by reducing the cost or increasing the benefit. Increasing the benefit in terms of increasing the revenue, increase the profitability, and reducing the cost means reducing the operation cost, whether you are producing goods, whether you are generating services. So always time you are focusing on less cost and more profit, right? Now, next is your core financial decisions. What do you mean by core finance decision? Core finance decisions includes related with the financial management that deals with the three major interrelated decision areas, because you have to run a business and you need to invest, you need to provide dividend, sometime you need to invest in the business again, you have to finance your business again. So always time you have to take different decisions. So most of the time your decisions are related with the investment, your decision is related to your financing your business with the profit you have in your hand, or you have to pay the dividend to your shareholders. So these three core financial decisions should be kept in a mind before taking any finance. So what is the first one? First one is your investment decision. Investment decision is related with the investment of money into the business. So these decisions relate to how the firm scarce resources are invested in a different assets to earn highest possible returns. So this decision will help you how you can invest your limited resources, key resources in terms of money, in terms of capital. You have a limited amount of capital, then how you can invest that amount into different assets like fixed assets or say tangible assets or intangible assets, so that you will be able to earn more profit with that particular assets, and the revenue or the profit that you are going to generate with that types of asset will help you to earn more profit. So this decision will help you have to invest your scarce resources into the business, and through that business, through that money, you are buying your financial assets or your other assets, intangible or tangible, and through that assets you are generating more and more profit. So this time type of investment decision will focus on the two types of investment: long-term investment and a short-term investment. Long-term investment is related with the capital budgeting. Capital budgeting that involves committing finance on a regular long-term basis, such as buying a new machinery, opening a new branch, or launching a new product line. These decisions are crucial as they affect long-term earning capacity, involve huge funds, and are generally irreversible. Right? So this type of long-term investment sense you have to buy a new machinery, new assets, new premise, new office, new branch you want to open, new product line, or diversified your product in a new area. So in this type of investment you have to do all these kind of activities. So your decision are very much crucial once you invest money for a long-term investment or you use your money for a long-term investment. So these decisions are crucial as they affect long-term earning capacity, right? Long-term earning capacity means the because you have a limited amount of resources, limited amount of capital in your hand, but if you are focusing on a long-term vision, long-term investment in terms of machinery, in terms of branch expansion, in terms of new product launches, then you should focus on your long-term earning capacity, how the business will able to earn profit for a long period of time, how the business will survive, how is the business will is generate a sustained amount of profit, yes, survival profit, so that you can survive for a long period. So this amount or this investment will help you to continue your business, and you need a huge funds, and this amount that once you invest in your particular machinery or say a long-term asset, you cannot back it into form of cash. You cannot convert them into cash by selling your long-term assets once again. So once the amount is investment, it is sank, it will be dropped, so you cannot get back to into your cash account, right? So it is a very crucial decision that you do for a long-term investment. Second is a short-term investment that is related with the working capital decisions, concerned with the levels of a cash inventory and a receivables, which directly affect day-to-day liquidity and the operation. This type of short-term investment basically related with the current assets and current liabilities of the business. So how much current assets you are having and how much current liability you have or you will use in your business to manage your day-to-day activities or your short-term decisions or say working capital decisions. So this is the short-term investment that you usually do in your purchase, buying the stock, maintaining the inventory, your BR, BP, your say bills receivable and bills payable, and stock and purchases. So this kind of investment is related with the money that you need to invest for a short term basis. So this investment is also important because through this investment you manage your day to day activities, your short term finances, short term activities in your business. Next, what are the factors that affect this capital bursting decisions? Capital bursting decisions related with the long term on, right? So first factor is the cash flows, second is the rate of return, and third is the investment criteria involved. So project cash flow in sense series of cash receipt and cash payment over investment life. Once you invest in a particular assets, how this that assets will generate profit for you, and how you make any payment, any expenses for regarding this particular assets that you purchase for running a business. Second, rate of return, expected rate returns calculated based on the project risk assessment, right? If you are investing in a particular project, and what will be the rate of return, how you will earn profit, and what percentage of profit you will earn in terms of profit, in terms of return. So you should be careful about expected returns that might be generated through that particular project. You have to also find what are the risks involved once you invest your money in a particular business, in particular project. So you have to be very careful about your investment, your cost that you will incur in terms of money investment, and how that particular project will help you to generate return in terms of revenue or the profit. Last criteria, that is your investment criteria. Evaluation techniques involve investment amount, interest, and cash flow. Investment criteria that evaluate techniques involving investment amount, how much amount you will invest, how much interest you have to pay to the source of this money, because you are investing the money but you have taken this amount or money from the bank or the financial institution, then you have to pay the interest. So you have to be very careful about how you generate this amount of interest. And the cash flows, cash flow is the net profit, sometimes the revenue that you generate from that particular investment. So you have to aware you have to be very careful about your revenue that you generate in terms of cash flow. You have to be very careful about cash payment or the payment in terms of interest that you pay for availing the service of your money that you have generated, that you have taken from the financial institution, or that you have borrowed from the financial institution. So these factors will affect your capital bursting decision. Capital bursting decision basically related with the long-term investment. You basically need money for a long-term investment. Short-term investment you can manage, but for a long-term point of view, you have to take or borrow the money from the financial institution like bank and any other institution who are helping the new business, new product development phase, new research and development expenses. So these banks will help you to develop something new, but they will charge amount in terms of interest. So you have to be very careful about this particular decision. Next, we are moving on the finance decision. Financing decision. This decision determine the quantum, means quantity, and the proportion of finance to be raised from the various long-term sources, primarily choosing between shareholder funds and the borrowed fund. So this decision basically will help you to identify how much amount you are really needed, how much amount of money you really needed, and how much amount of money or the proportion of finance you will raise from the long-term sources. Financing decision means you need a quantum of money, you need a certain amount of money, but how you raise your long-term finance from the long-term sources. Long-term sources means the bank who is ready to pay you for pay you loan for a 10-year, 20-year, or 15 years, say. So these are called long-term source of finance. Primarily choosing between the shareholder fund or the borrower fund. Shareholder funds, shareholders who are ready to invest in your business, they are called shareholder funds because they will invest fund in your business. Their fund will be shareholder fund, and the borrower fund that you borrow from the market. So you have to identify which source of finance, which amount of money that you can raise from the shareholder funds, and how much amount you can raise from the borrower's fund, your borrowed fund. So there is a kind of alignment you have to do. There's a kind of balance you have to make between shareholder funds and the borrowed fund, because you are primarily concerned with financing decision. Financing decision will relate with the amount of money that you require to be invested in your business, but that amount, how will you raise from the various long-term sources, whether you have to take all the amount from the bank, whether you are ready to take all the amount from the shareholders, but both are not available. Then you have to balance it. Some amount of money from the shareholder fund, some amount of money from the borrower funds. So in this way, you can help your business to sustain and grow with the help of two types of funds, that is a shareholder fund and the borrower fund. But what type of business you are doing and what type of finance you will require will help you to identify this kind of financing decision. Next, we are talking about debts versus equity. Debt in sense that you borrow fund. As I told you earlier, you have to borrow the fund from the market, that is called debt, or the investor will invest in your company, that is the equity. So there is a alignment, there is a balance that you have to create between the debt and the equity. So what amount of debt you are using then when you borrow from the market, or what amount of equity you will use when you are raising from the shareholder fund. So debt is cheaper due to the tax deductible interest, but carries higher financial risk. Equity carries no objection for repayment or a fixed dividend, but may dilute the management control. This will help you identify what is debt and what is equity. Equity and debt means you are taking the finance from the market, but you have to be very careful, because no doubt you have to pay no tax the interest you pay to your borrowers to whom you have borrowed the money, because these are tax deductible interest, and you do not have to be pay any tax on the interest you pay to the borrower. But there is a high financial risk sometime, because it is a obligations, it is a mandatory to pay the interest on time to time on every month, on a regular basis. You cannot ignore that liabilities. They are external fund, they are external debt creators. You have to pay them money on a regular basis, or say month to month basis. So no doubt this debt is cheaper, but you are having or bearing the obligation of paying the interest on each and every month. Equity share or equity carries no obligation. You do not have to pay the interest, you just have to pay them the dividend. But dividend you have to pay. It is the not obligation. Sometimes you can declare dividends, sometimes you cannot. So you can inform your shareholder in advance. From that years we are not going to pay you this dividend. Next year we will pay you. So there is a no obligation for repayment or fixed dividend, but may dilute your management control, because as much as you have equity shareholder in your company, your control of the company will be in their hand. They will try to make the company in their control. They will try to make the decision according to their own will. So sometimes this might impact the business and its growth and its survival factors. So you have to be very careful about debt and equity between that what you choose for your business. Next is your factor affecting the financing decision. First factor is your cost. Second is a risk. Third is your flotation cost. Fourth one is a cash flow positions. Fifth one is a fixed operating cost, and sixth one is your control considerations. But so these are the financial decisions, and are the factors that will affect your financial decision in the particular sense. Cost, it's what is selecting the cheapest available source of raising finance. What are the sources that you can get money? What are the sources from where you can get money, or you have to pay very little amount of cost to them? So this is the factor that affect the cost condition. Risk, evaluate the financial risk associated with the different funding option, because you can take the money from the different source of finance, but which source is more riskier, which source is less riskier, you have to focus. This is all about. So you have to evaluate the financial risk associated with the different funding option. Suppose you are taking the money from the bank, you are taking the money from the private investors, you are taking the money from any other private financial institution. So who is charging more in terms of interest? Who is charging less in terms of interest? You have to identify that risk as well. You have to focus on that risk as well. To whom will you need to pay whole amount at what time? To whom you have to pay regular amount with the no obligations? So these kind of risk is also involved once you take your funding option, your funding sources. So risk, evaluate financial risk associated with the different funding option. Next, flotation cost, expense incurred during the fundraising exercise itself. Flotation cost, sometimes you have to pay the amount before you uh, take the finance from the particular bank. The floating cost is what? Floating cost in terms of expenses that you usually incur, that you have to pay to raise your fund, or to raise your finance, or to get your fund exercise to the particular source of finance, because they will charge stamp duty, they will charge commission, they will charge any other amount in terms of taxes, GST. So these are the flotation costs that will that will you have to pay to get your money from there, that you get your money from there in order to run your business. So these are the minimum expenses, or the say expenses that you have to incur before you raise your fund from the financial institution. Next one is cash flow position, viability of the servicing debt through steady cash inflow. Cash flow position means viability of the servicing debt through steady cash inflow. This is particularly related with the revenue you are incurring, and simultaneously you are paying your interest in terms of service debt. Servicing debt in sense, the debt you have taken from the market, the debt you have taken from the financial institution, you have to serve them. Serve them in sense, serve in terms, you have to pay them interest. So once you have taken the debt, you have to pay the interest. So your business should generate sufficient amount of profit, sufficient amount of revenue, so that you can pay your debt on time, or you can pay the interest on time. So this is a cash flow positions that you consider while decide your financial decision. Next is your fixed operating cost. Lower debt preferred if fixed operating the overheads are high. If fixed operating cost is high, right, then you would definitely go for lower DAP preferred. If fixed operating overheads are high, suppose someone is charging a huge amount of interest, uh, sometimes they are charging huge GST, huge amount of GST, huge amount of commission, then you have to be very careful about taking the money from that sources. You should go for lower DAP preferred. Lower debt in sense that you can take less amount of profit, less amount of money from the market, and rest you can focus on your shareholder fund. Because what we are just comparing what sorts of finance will be good for our business, what sorts of finance will be having a greater impact on our business. So if you are having a fixed operating cost in which lower debt preferred, if fixed operating cost overheads high, then you will definitely go for low debt amount from a particular source of finance. If you have to pay fixed operating costs regularly, and if it is high, then definitely it will be more than, sometimes it is more than your revenue, more than your profit. So you should focus on taking less and less amount of money from that financial institution or that source of finance. Next, control consideration, fear of management, control dilution, reduce equity issuance. Control consideration, you need to focus on that. If you are taking the money from the financial institution, then there is a fear of management control, dilution, reduce equity issuance. Most of the time happens in your business. If you have a control in your business, but you are taking more finance from the financial institution, then control of your business will divert it or dilute it to that particular source of finance. So in this way, you are not able to issue equity or equity shares that will not going to help your business. So in this case, you have to be very careful about control consideration. You should focus on less amount of profit, less amount of money from the particular source of finance, so that you should not dilute your control to them, or you should not hand over the control of the business to them. You should merely focus on what amount of money I can take from that financial institution, and rest I can collect, or I can uh, get the source from my own sources or from my own resources. So you should be very careful about fear of management control dilution that reduce the equity issuance. State of capital market, that is a bullish trends easy equity, bearish market favor the debt. This is one of the particular factor again that will help you. If you see the market in a bullish trend, market is rising, then you can easily take the equity from the market. You can issue your share, and the equity shareholder will buy your share and they can invest in your company. But if there is a bearish, if there is a sluggish, if there is a slowdown in the market, then it is good to take money from the debt or the financial institution. So state of capital market will help you. If your market is going on a higher side, then you can issue your equity share and you can take the money from the investor. If your market is going on the bearish side, sluggish side, or a downside, then you can take money or a finance from the financial institutions. So it is good to understand bullish trend will help you uh, to get more money from the equity shareholder or sometime the investor. If you are having a bearish market condition, then you can favor the debt that you can money that the money you can take from your financial institution. So this is a factor affecting your financial decision. Last, we are approaching to dividend decision. Dividend decisions involves determining how much of profit earned by the uh, company after tax is to be distributed to shareholder as dividend. It means this decision basically involved what? How much amount of profit that you need to distribute to your shareholders after deducting a certain amount of tax that you have to pay to the government. Because once you pay a certain amount of tax out of the profit, so remaining amount that you can distribute among your shareholder. So the profit earned by the company after tax is to be distributed to the shareholder as a dividend. So this is what the dividend decision. How much dividend you can pay to your shareholder after deducting a tax amount from the profit that you generated in that particular year. Because you have to uh, announce the dividend on yearly basis, and this dividend will help you your business or your organization to get the money from the investor on a regular basis. Because if you are not paying a dividend on a time, then they might withdraw their funds from your business. So this is very crucial decision in terms of paying the dividend. And how much should be retained in a business to finance future growth. Because you cannot distribute all your dividend, all your profit. After deducting a tax, you have to pay a certain amount or in form of dividend, and certain amount you need to retain. You have to balance in your account so that that amount can be reinvested and plugged back into your business, so that it will help you to generate more business, more further business activities. So you have to be very cautious about dividend decision. Now, what are the factors that affect your business dividend decision? First factor is your amount of earnings. Payout really rely heavily on the current or past profit. Whatever amount of earning you want to pay to your shareholder, definitely it would be based on your current or past profit that you have generated in last year or last to last year. So amount of earning definitely should be high so that you can pay dividend to them on time to time, and the rest amount you can save for your business for in further investment purpose. Next, stability of earning. Stable corporate earning allow higher dividend declaration. If your company working in a form of corporate business, then your income should be stable. If you are earning a stable corporate income, then you are able to announce a huge amount of dividend on a regular basis, and it will help you to design your dividend criteria, dividend payout situations, and you can save your for a business after paying a certain amount of money for your dividend, or after paying a certain amount of dividend to your investor. So stability of income will help you in a two types of uh, s- sustaining your business. Once you can pay for your investor or the equity shareholder. Second, you can survive. Second, you can invest in your business to survive your business or generate more revenue for further time for further business. So this will help you to stabilize your earning. Third one is stability of the dividend. This is the maintaining a consistent dividend payout per share. Stability of dividend. If you are paying a same amount of dividend every year, then it reflect what? It reflect the stability of a dividend every year the company is paying to its investor. So maintaining a consistent dividend payout per share, then you are in a good conditions, because investor will trust you, investor will identify your credibility. Investor is clear about your visions, about your business, about its profitability. So they will definitely help you to generate more profit by investing from their end. They will invest in your company because you are giving them a stable amount of dividend every year. So this will help them to give you a kind of support in terms of in terms of money, in terms of moral support, in terms of sustaining your business. So in every matter, they will help you. Next, growth opportunities, retaining more profit to finance lucrative investment avenues. If you are paying a regular dividend, definitely it will help you to retain more profit for in your business to finance further lucrative investment that you can invest, further lucrative project invest, project that you can or your company can invest. So growth opportunities will relate with the how you can further invest in our business, invest in your project that will help you to generate more and more profit. For next is cash flow position. Availability of sufficient cash determine actual distribution abilities. If your business have a ample amount of cash, ample amount of money in the account, then sufficient amount of profit that you can distribute to the shareholders. So this will help you to identify your cash position, that not only for the distribution of dividend but also for your business growth. So availability of sufficient cash determine actual distribution availability. Next, shareholders' preferences. Considering investor expectation for a regular cash income. Shareholder preferences reflect what? It is considering the investor's expectation for regular cash income. So in this way, if your shareholders' preference is quite clear and transparent in terms of their dividend, and you consider investor expectation for regular cash income, or if you consider that your investor or a shareholder wants regular income, then you should pay them. You should try to earn that much amount of revenue or a profit from your business that you can give them on a regular basis. So in this way you will gain their trust, gain their credibility towards your business. Next is the taxation policies. Adjusting payout based on the varying tax treatment of dividend. Adjusting payouts based on varying tax treatment of the dividend. Sometimes the government change the tax rate. Sometimes the government change the amount of tax that the business has to pay on their profit. And once they charge a profit and the rest amount in a form of dividend that they can distribute to the shareholder, to their as well as they can keep with their business. So taxation policies also focus on how you pay your tax, how you pay your dividend, your shareholder, how you save for your business point of view. So you have to adjust your payout based on the varying tax treatment of the dividend. Next, stock market reactions. Positive price movement typically followed dividend increases. Stock market reflection or stock market reaction also impact your dividend decision. So if you have a positive price movement, then typically dividend increase. If your price is increasing in the market, or price related with the shareholder, price related with the shares is increasing, then definitely dividend will increase, because you have a good approach in the market, you have a good credibility, good trust in your in your business. People are trusting you, people have a credibility in your business activities, observe credibility in your business activities, so definitely they will try to invest in your company. And a stock market reaction will definitely show a positive signs towards your business as well. So you must be very careful about stock market reaction. Next, access to the capital market. Reputed firms raise market funds easily, paying a high dividend. If your company comes into the reputed firms, if your company projected itself as a reputed firm, then definitely they raise market firms, they raise market funds easily and paying the higher dividend, because they know that we have a good we have a good market share, we have a good amount of product, we have good amount of services, people are purchasing from us, so we have gained a huge market. So this reputation of the firms will help them to raise market fund easily, and they would be able to earn more profit, and once they earn a more profit, they have a ability to pay a higher dividend. So in this way, your dividend decision will help you to access to the capital market. Next, legal constraint. Legal constraint is related with the restriction placed on the payout by the Companies Act. According to Company Act, your payout should be legally bind. You have to pay a certain amount of dividend that is shown as per the Company Act or as per the company compliances, that you regularly pay, that you should regularly pay to your say shareholder or the investor. So you cannot pay all the dividend from your profit. You cannot 100% pay out the dividend. You cannot pay 100% profit in terms of dividends. So you have to restrict your profit. You have to restrict your profit to a certain level that is actually help you to generate, that will actually help you to give that amount of dividend which is very much required to pay for the investor. So you should be very careful about the legal constraint. Last one is a contractual constraint, restriction imposed by the lender via loan agreement. Contractual constraint in sense, restrictions imposed by lender via loan agreement. Sometimes when you take the loan from the particular lender, they will charge you, they will restrict you, that you cannot distribute your dividend more than this percentage, yeah, more than this amount, or more than this more than the interest you pay to us. Because once you take the loan from a particular lender will definitely charge you interest. So they will restrict you, you have to pay the interest first of all, and then you can pay dividend to your shareholders. We do not have any problem, but sometime they can restrict you restrict you for paying the dividend that you are going to pay for your shareholder and for their capital invested in your business. So you should be very cautious about your contractual constant as well. So this is the decisions that you usually take during the money raising situation or the fundraising situation from the market. So you should be very careful about these core financial decisions, and these core financial decisions will help you to identify what type of business or what type of corporate activities that that you are willing to do, or that the organization is willing to do, they how they raise the money from the market. They should be focused on the investment, they should be focused on their financing decision, they should be focused on their dividend decision. So every time they should focus on different criteria to get the money from the market. So thank you for this session. Thank you for this particular video, and thank you for listening from right to end. And definitely this video will help you to understand very important topics about the financial market. Thank you very much. See you in the next video with a new topic.